Well, hello, everybody. Thank you so much for joining us today. Thank you for your patience as we took a few extra minutes to put a bow on top of this before we get started. It's a privilege to be here with you today. My name is Charlotte Roberts. You are all in for a great treat as we study leases, heavily tested on the FAR section of the CPA exam with yours truly, Peter Olinto and Dr. Megan Burke. So I'm going to do a couple quick slides to get us started, and then we're going to turn it over to you, Pete, to teach us all about leases. If you wouldn't mind going to the next slide for me. I get to boss Peter Olinto around for a little bit today.
Let's go. Let's go. You like that, don't you?
I do. I will say I do. So for those of you joining us today that are already studying and passing CPA exam sections with UWorld, thank you for allowing us to partner with you through this presentation and through your course studies. For those of you still learning a little bit about UWorld, we are the proud leader in education technology. You'll see here we have helped over 4 million students, professionals, candidates pass a wide variety of high-stakes exam, everything from medical, nursing, bar review, even some of our college prep, and then Megan, Peter, and myself, all with the privilege of serving in our College of Business, CPA, CFA, and CMA. Next slide, Pete. Specifically on the CPA.
You got it. You got 4 million. 4 million. You sure it's 4 million? Did you count that? It's like McDonald's. We serve 4 million. Wow. Let's go.
With more and more every day, including some today after this Leases presentation, I guarantee it.
Great.
Specifically within our CPA review and exam prep, we're very excited. As you'll see here, it's not just exam prep. As you'll see today, as we study leases, we are going to ensure that you are career ready. We are exceptionally proud of our 90% CPA exam pass rate. We all know the CPA exam is difficult, but as Pete's going to say, you can pass it and it will definitely be worth it for you and your career. I will be able to speak a little bit more to that proven 90% CPA exam pass rate somewhere in the middle of the leases conversation today. So I'm going to assume that dollar sign is to be able to earn more money and earn more career potential once you pass the exam. Is that right?
Well, I'm actually hoping they'll kick me back part of that big bonus they get if they pass that exam within the first year of working. That's what I'm hoping for.
Yeah, and those we're hearing those bonuses are increasing. So let's try to get them all that we can. So next slide here before I officially turn it over to Peter. So as mentioned, my name is Charlotte Roberts. I serve as the VP of e-learning with accounting and finance. For those of you that have ran around in Beta Alpha Psi, we've probably seen each other on campus. I'm also going to introduce Dr. Megan Burke, which Peter is currently making, I'm going to think, some sort of a pirate here.
It looks like Megan, I'm turning into a pirate, or maybe.
Yes. Expect no less. Megan is joining us today with a great teaching experience across the sections of the CPA exam. I know Megan's going to be in the background. One of the things we're really encouraging you all to do today is if you have questions as Peter is presenting on leases, please, please, please feel free to populate that questions area within the webinar so we can get those addressed and answered for you. In addition, today, for your viewing pleasure, it will be recorded. So anybody who signed up for today, you will get a recording of this presentation. Thank you, Peter, for saying I'm the best. You are not a juvenile delinquent. You are silly and crazy at times, but I think that's what we love about you, and that's what students also love as well. So with that, if you're done pointing us all out, I can turn it over to you officially to teach us about leases.
What's happening, everybody? Peter Olinto with you. I am excited to be with you. I know doctor, give me the news. I got a bad case of loving leases. Let's go, Dr. Megan Burke. Oh my goodness. And look at Charlotte. She's a VP. Damn. You guys are like big wheels. I'm over here. I'm just me. Well, we are excited. Yeah, we're going to teach you everything you ever wanted to know about leases and more. We are not going to wait to get to questions. So what we're going to do is behind the scenes, you could put in the chat, Dr. Megan Burke is going to be in between doing surgery. She'll be answering questions about leases. So you don't need to hesitate. You don't need to wait. You could send in those questions as we go along. I am going to teach you exactly what you need to know about leases. And people ask, Pete, why do you do these free events? Because we need to earn your business. And certainly this is free monetarily, but it is certainly not free in terms of your time. So we are going to use your time wisely. This is kind of a sample of what our actual pre-recorded video course looks like, where we teach you the content, walk you through examples, etc. But in addition to that, and Charlotte will talk about this later, truthfully, FAR, BAR, and to a certain extent, Reg and TCP, where students are struggling, it's with the task-based simulations. So we have an entire video series led by Dr. Megan Burke. That's right. She will be performing surgeries on those task-based simulations, breaking them down for you step by step. So not only do you understand the content, how to apply it to multiple choice, but then also how, obviously, to apply it to a task-based simulation. Lease is one of those topics, leases that lend itself well to task-based simulations. I do live boot camps like this for the regular course once you're an enrolled student. And those live boot camps are an opportunity for us to work with you the more difficult multiple choice as well as task-based simulation. So we've got you covered in every which way. All right, so I'm excited. We're going to bang it out, and away we go. All right, CPA, leases, 2 for 1, folks. You're going to see this. Now, look, everybody's shying away from BAR because of the pass rate. Listen, my friends, especially if you're on the audit side, not the tax people, you're doing the TCP. But look, if you do well in FAR, you should absolutely go to the BAR. That's right. In addition to celebrating at the BAR, man, it's 2 for 1 because you're going to see leases again. In FAR, we see it mostly from the perspective of the lessee or exclusively the lessee. But then in BAR, you'll see it again from the perspective of the lessor. So that's pretty cool. Investments, consolidations, we see both in FAR and BAR. Some of the governmental not-for-profit, we see in both FAR and BAR. And look, if you did well in corporate finance, if you like cost and managerial, if you like the math-intensive topics, I'd give BAR a shot. In UWorld, we like to have objective evidence when guiding you with respect to the discipline. So we don't mind waiting to see, like, if you sit for FAR first and do really well, man, you should be taking BAR next because of the overlapping content. If you pass FAR, but you don't like it so much and you're on the audit side, obviously you could do ISC or TCP, but see how you do in FAR. You might like it. All righty. So with that being said, what we do in all of our classes for all of the topics, we want to make sure you understand the representative task. Like, what are they going to ask me to do with this information? Is it going to involve math? Because boy, do I like the math. Yeah, calculate, because you know what? Once you understand the concept and the formulas and etc., the journal entries, you get it right every single time. Some of the theory items, you'd be shocked, like in audit, ISC. Even though there's no math involved, I found those questions to actually be more challenging because there's not, a formula involved. So I like when there's formulas. I like when there's journal entries because you get it right every single time. So part of what they're asking you to do is, first of all, classify that lease. Is it an operating lease or is it a finance lease? My friends around the world, capital lease, whatever you want to call it. But there's 2 ways to account for leases, as we're going to see. Actually, 3. Because if it's a really, really short-term lease, you don't have to do any of this stuff. You don't have to book an asset and a liability or just record your rent expense if it's really short. But outside of that, mostly what we're going to be looking at are the operating leases and the finance leases, sometimes called capital leases. We're also going to look about, well, what do you do if you got a residual value? You've got a guarantee. We'll talk about how that affects the present value of that lease obligation. If you got a purchase option, variable lease payments, there's all these different things they could ask you about. But today we're going to focus in on primarily the nuts and bolts, the math for both an operating lease and a financing lease, and how you know when to capitalize and record a financing lease versus an operating lease. Okay, so step number 1, the criteria that you're going to have to use to account for that lease. Okay, how do you know if it's a financing lease or an operating lease? So that's what we'll discuss first, and we'll talk about being a snob. You don't want to be a special kind of snob, or maybe you do. I don't know. We'll find out. All right, first of all, a lease, you'll see this again in business law because it's a contract, a legally enforceable agreement where the lessor, who the owner of the property is giving control to the lessee. Okay, the lessee is the tenant, so we always want to keep track. The lessee, multiple parties in the facts, that's the tenant. They're using the property. The lessor, that is the true owner of the property. But as we've already mentioned, FAR is focusing in on the lessee. So the question becomes, what do we mean by control? When do you get control? Okay, so that's going to be a key concept because that's when we're going to start recording our expense. Okay, so the clock will be ticking. All right, so the right to control that identified piece of property, that PP&E, whatever it may be. So the definition of control for our purposes, and you're not writing an essay, it's about recognition, not memorization. Hey, do you have substantially all of the economic benefits, okay, from that asset's use, and can you direct that asset's use through the contract period? So it's really about, do you have substantially all the economic benefits from the use of that property, as we're going to see. Very exciting. All right, now they got pictures. You ready? Check it out. Well, see, I don't have a beard. I used to look like Abraham Lincoln, but I shaved. Megan said I had to shave. So Megan is the lessor. She's the owner of that property, okay? We will predominantly look at that in BAR. But the good news is, if you do well in FAR, as I mentioned, this is the flip side of the coin. One side makes the payment. The lessor is obviously receiving the payments. We're focusing in here on Abraham Lincoln. Let's go. Abraham Lincoln is the lessee, also known as the renter. They have the right to use that property. They're the ones who are making the payments, okay? Now, be very careful. We are accrual basis, not cash basis. So I don't care when you make the payments, okay? The expense is going to be recorded according to the matching principle, all right? So we're accrual basis, not cash. So silly mistake is to try to record that expense when the payments are made. We're not going to do it that way. And of course, you're not going to make those silly mistakes. So next thing, your date for Friday night, whatever you were going to do, cancel those plans. When are you going to account for the lease using the financing lease rules? Now, I like my own kind of acronyms where they're silly. So when you're a special kind of SNOB, a special type of snob. So maybe this property is specialized for you, okay? So the lessor has no use for this property. You wanted it. They created it for you. So if it's specialized for you, that lessee, financing lease. And you don't have to meet all of these criteria, any one of these 5, and you're going to book it as a financing lease. Okay, the S is the 75% test. Is the term of the lease greater than or equal to 75%. Now, US GAAP is following more like IFRS now. It doesn't have to be exactly 75, maybe 70, 73, 74. But to make it obvious on the exam that the term is a major part of the asset's economic life, 75% is a pretty good benchmark, okay? They're not going to mess with you. It's either going to be 50%, or 75, 80%, all right? So that's the S test. The N test, the 90% test. Is the present value of that lease obligation greater than or equal to 90% of the fair market value? If it is, it's as if you bought this damn thing. All right. So if you bought it, basically, because when you look at all the lease payments, the present value of those lease payments is as if you bought it. Well, then you know what? It's a financing lease. Again, does it have to be exactly 90%? No, maybe it's 88, 87. But basically, substantially all the present value of that lease obligation, man, is really close to that fair market value. It's as if you bought it when you look at all those payments. Maybe you meet the O test. The O test is you got ownership, you got title. So if you own it at the end of the lease, they transfer title to you. Well, then if you meet that, you're going to record that as a financing lease. Or you have the option to purchase this thing at such a ridiculously low price at the end of the lease. There's no way you're not going to buy it. The B stands for a bargain purchase option. Bargain purchase option. So you meet any one of those 5. What are we going to book it as? A financing lease. If it's a financing lease, you're going to record amortization, kind of like depreciation, and you're going to record interest expense. Amortization expense, interest expense. All right. If it's an operating lease, why would it be an operating lease? 0 for 5. You didn't meet any one of those 5 criteria. Then what you're going to be recording instead is lease expense. And I'll talk about how to calculate that, but it's not the cash paid. All right. So That's your date for Friday night, Saturday night, whatever you're going to do. So it's not uncommon on the exam that they want you to determine, hey, is this an operating or a financing lease? So I always start with the requirements, not the facts, because I don't know what to do with that paragraph worth of information. But now that I've seen what to do with it, I think immediately, are you a special kind of snob? Do you meet any one of these 5 tests? If you meet any one of these 5 tests, then it's a financing lease. So let's see. We enter into a 20-year lease on an office building. The asset's got an estimated useful life of 30 years. All right, that's our 75% test. 20 divided by 30, that's only 67%. That's less than 75. So we're going to say no for that. The title does not transfer. No transfer of ownership. Title does not transfer. Colton is not offered. There's no bargain purchase option. The present value of the lease payments is $450. That's, let's see, what percentage of 600,000? So let's see, do we meet the 90% test? 450 divided by 600, that's only 75%. That's less than that 90%, okay? If it were like 87, 88, that would be good enough. If that 67 were more like 73, 74, 75, that would be good enough. All right, so is it specially manufactured for this lessee? Does it have a special use where the lessor can't use it? Nothing about that. So we are 0 for 5. So what's it going to be? An operating lease, not a financing lease. So you do it one at a time. All right, so there's no amortization. There's no interest expense if it's an operating lease. All we're going to record is lease expense, and now you're about to learn something new. When it's an operating lease, you're going to record that lease expense straight line. And I'll show you exactly how to do the straight line. We're going to take the total payments, and then we are going to divide it by the useful life or the term of the lease. I'll show you how to determine which is which. And then we will get straight line lease expense. All right. And that's what we'll record every period according to what principle? The matching principle, because we are accrual basis, not cash basis. All right. Next up, and Julie, I got to shut my camera off. I keep looking at myself. Come on, man, I got to get rid of this thing. Oh, there we go. It's distracting me. Sorry, Julie. Julie's going to want to stab me after this. Okay, so I like to use special. Megan, do you say special or special?
I mean, I generally try to just say special, but you know, that's just me.
It might be
as much coffee as you. Maybe if I had as many cups of coffee as you did, I would also special it.
All right, so financing lease, I'm losing my mind. When you have a special snob, you don't meet any one of those, then you're going to be an operating lease. Any one of the 5 financing lease, okay? So in our example, we know we are an operating lease, baby. An operating lease, you're thinking no interest, no amortization. All right, love this slide. You ready? Financing lease again, any one, not all, any one of the 5, then it is a financing lease, okay? It's as if you bought it on credit, okay? It's kind of like you bought it on credit. So it's as if they purchased the asset on credit. So if you purchased the asset, you'd have to record amortization expense, kind of like depreciation, okay? But you don't really own it, okay? So we're going to call it amortization, not so much depreciation, which implies ownership of a tangible asset. And since we're pretending you bought it on credit, borrowed funds, what else are we going to have to record? Interest expense. All righty. Operating lease, you are not 0 for 5. You didn't meet any one of those criteria, so 0 for 5. So it's kind of like a rental agreement. Ownership is not transferred to the lessee. So we're just going to record straight line lease expense. More times you write it, you hear it, you read it, you'll remember it, you'll take the exam, pass it, and then you can forget it. But folks, here's the key point. The key point is operating lease or financing lease. Step number 1 at inception. Whether it's an operating lease or a financing lease, what are we going to do? We're going to debit a right of use asset, and we are going to credit lease liability. And the lease liability is the present value of the lease obligation. The right of use asset is the present value of lease obligation plus or minus some other stuff, which we'll talk about. All right, but I don't care if it's an operating lease or a financing lease. Step number one, at inception, you're putting that asset on the books, you're putting a liability on the books, operating or financing lease, both of those. All right, so that's very important because that's not the way it used to be. All right, so both financing lease and operating lease on the balance sheet. We've got an asset and a liability. That's the general rule. Unless it's a really short-term lease, less than a year. Okay, but that's the general rule. Okay, now the lease term. You ready? What is the term of that lease? Well, it's the period of time the lessee is reasonably expected to lease that asset. All right, so we're going to look at the commencement date plus. So first of all, you have your initial lease term. That's going to be given information. But then we're looking for other stuff like, hey, you know what? There's a renewal option that is likely to be exercised by the lessee. Then that'll make the term go up. That'll make the term go up. Or the option to terminate is unlikely to be exercised. Okay, so that means we're going to use the full term. Renewal option is controlled by the lessor. Presume, if that's the case, you're going to presume they renew, the lessor renews, that will make the term go up. So just as an FYI, the lease term is normally just stated, given information, but if they tell you there's an option that's likely to be exercised by the lessee, add it. If they tell you the renewal option is held by the lessor, presume they're going to renew it because they like that cash flow stream. That'll make the term go up. Okay, if an option to terminate is unlikely to be exercised, then ignore that. Okay, it's going to be the full term. They're not going to end it early. All right, general rule, folks. This is what we're going to see most of the time on the exam. So long as that lease term is greater than 12 months, we're either going to have an operating lease or a financing lease. We're going to recognize an asset and liability. The exception, and that's why we don't like the words all, always, never, must, or only. Whenever you see these words, all, always, never, must, or only, what a great way to make a seemingly correct choice incorrect because it's too extreme. So most of the time, we're going to recognize an asset and liability, but not always. Okay, if it's a really short term, less than 12 months, just a few months, then there's no asset or liability. No asset or liability. Just record your rent, lease expense, whatever you want to call it, rent expense or lease expense. Okay, but no asset or liability on the balance sheet. But that's the exception, not the rule. Okay, so obviously those are our basics. That's our introduction. Get you guys all excited. So what did we say? Lessee is what we're focusing in on in FAR. All right. Operating lease. When is it an operating lease? When you are not a special snob. You're not. You're 0 for 5. You didn't meet any one of those criteria. Okay. So step one, at lease inception. I don't care if it's an operating lease or a financing lease. So long as it's more than a year, what are we going to debit? Right of use asset, and we're going to credit lease obligation, okay, whether it's an operating lease or financing lease. Now, these two are usually the same, but not always. The lease obligation is always the present value of the lease obligation. The right of use asset could be that number plus or minus some other stuff. That's the cliffhanger to get you back in a little bit. All righty. Then we're going to record under the accrual basis, not cash basis. I don't care when you make the payment. We are going to record the following expenses. One of two, no interest, no amortization. What did we say to record? Lease expense. Straight line, no amortization, no interest expense. You'll credit your lease liability. That'll make your liability go up. the beginning carrying value of your liability times your interest rates times, be careful, watch your dates, the number of months over 12. Okay? And then you will credit your right of use asset. That will be your plug figure. So we are going to know this number, the lease expense, that straight line. We'll know the lease liability number because we're going to calculate that. Then the right of use asset is your plug figure. That makes your asset go down. This makes your liability go up. Journal entry 2 of 2 when it's an operating lease. You will debit your lease obligation and you will credit cash for your actual payment. Okay, that's going to be a financing outflow, by the way, folks. That'll be a financing outflow. When you reduce that liability, that is a financing outflow. Got it? There it is. So that's an operating lease. That's the overview. Now let's dig into the details. All right, so as always, what do we do here at UWorld? Remind you, hey, anytime it's not just remembering or understanding, when they start getting to higher level skills, applying it, etc. Okay, you know, probably going to make for you could make it for a good task-based simulation. Do me a favor, the carrying value of the asset or the liability, use T accounts. Don't memorize these long amortization schedules. No. T accounts, man. That's the way to do it. Okay, and then calculating our lease expense, again, makes for a good task-based simulation. I'll show you how that works in just a little bit. All right, so our initial entry, this is for both an operating lease and financing lease, so long as we're greater than or equal to 12 months. Okay, the initial entry is the same. Your lease liability, that's the present value of your lease obligation. Your right of use asset is that present value of lease obligation plus or minus some other stuff, which we'll talk about in a second. All righty, ready? We're going to have to deal with annuities. Why? Because we got multiple payments of the same amount. So how do we get the present value of a lease payment? It's simple. Does the first payment begin immediately, starting now? If the payment begins immediately, first payment happens now. Okay, starting today, we start making payments, starting today. Right? If that's the case, then we need the present value factor of an annuity due. Present value factor of an annuity due. Tell me the number of payments. N is going to be your number of payments. Tell me what the lease rate is. The rate implicit in the lease. Now, if they don't give you the rate implicit in the lease, then they got to give you the lessee's incremental borrowing rate. But we first look for the rate specifically for this lease. If they don't give you that, what's secondary is the lessee's incremental borrowing rate. Okay, then we take that payment times that present value factor of an annuity due, and there's the present value of your lease obligation as a general rule. Okay, so no longer is there's no guaranteed salvage value or any of that stuff. Okay, if the payment happens at the end of each year, the payment happens at the end of each year. Then we need the present value factor of an ordinary annuity. Again, for N number of payments, and then I, tell me the lease rate, and if they don't give you the rate implicit in the lease, what do we use instead? The lessee's incremental borrowing rate. Now, to make this challenging, this is as hard as they can make it. The first payment begins immediately. All right, listen to me carefully. So you're looking for the present value factor of annuity due because the first payment happens the same day we sign the lease. And you're like, oh my God, they didn't give me the present value factor of an annuity due. What do I do? Well, if you took some other course that rhymes with wrecker, you panic and you get it wrong. But if you're with UWorld, and it's a whole new world now, baby, there's a new sheriff in town. You're going to get this right. You're not going to panic. You're going to look at the record person sitting next to you and smile at them while they get it wrong because you're going to remember the present value factor of an annuity due. Let's pretend it's for 5 payments, and let's say the rate is 10%. But this is not given. Okay, first payment begins immediately. 5 payments, interest rate is 10%. But that present value factor of an annuity due is not given. So if you take that other course, you panic, not you. What are you going to do? You're going to find the present value factor for an ordinary annuity for n-1 periods. All right, so that would be, in my example, 5 minus 1, 4 periods. You're going to find that present value factor for an ordinary annuity. Take that factor and add 1. That is then the present value factor for an annuity due for 5 periods. You'll find it yourself. That's about it. It's about as difficult as it can make it. All right, so time value of money, piece of cake. So if the first payment begins immediately, you're thinking, I need the present value factor of an annuity due. If they don't give it to you, don't sweat it. 5 payments minus 1 will find me the present value factor for an ordinary annuity for 4 payments, then add 1 to that. And there becomes your present value factor for the annuity due. That wasn't given explicitly, but they gave it to you implicitly. All right. Journal entries, journal entries, journal entries. They love me some journal entries. All right. First thing is the present value of free rent to entice you to make improvements. It's going to, you're like, listen, I got to fix this space up. The prior tenant was a pig. Place is a mess. It's going to take me 3 to 6 months to fix this up. The landlord says, you know what? First 6 months of rent are free. The present value of any free rent reduces the present value of the lease obligation and thus the right of use asset. That's all if they give you some free rent. All right. Step number 1. Operating lease and financing lease, so long as it's greater than or equal to 12 months. What do? We record the asset, we record the liability. Okay. Now, subsequent entries, what do we do thereafter? I don't like one long journal entry because my brain is too small. Megan's a doctor. She's got a big ass brain like this. You got to see her head. It's like this. She's like one of those characters from Star Trek because she got a big brain.
I do have a big head, though. I have to wear big hats. That's true.
I got a little itty bitty brain. So I like everything in 2 journal entries, 1 step at a time. You ready? So if you're a doctor, you're going to do it in 1. Now me, operating lease, I'm going to do 2 journal entries. Slow and steady wins the race. You ready? 1 of 2. I'm going to record my lease expense. Straight line. I'm going to debit my lease expense. I'm going to credit my lease liability. That I'm going to calculate. How am I going to do that? The beginning carrying value of the liability times the rate times the number of months over 12. And then I will credit my right of use asset. And that number is my plug figure just to make my journal entry balance. Okay. Then I'm going to record journal entry 2 of 2. I'll debit my lease liability. Sorry about that, guys. I will debit my lease liability. 2 of 2. Debit my lease liability. And I will credit my cash payment. That's it. I like to do it in 2 steps. Slow and steady wins the race. Now, obviously, if it's a TBS and they set it up for 1 journal entry, no worries. Write it out as 2 and then combine them. All right, so you're going to have 2 debits and you're going to have multiple credits. All right, that's it. No big deal. All righty. So let's take a look at an example. Oh, actually, before we do that, how do we record lease expense under an operating lease? You ready? The lease expense starts accruing. Come on, man. Starts accruing once lessee gets control. All right, control. And I'll talk more about that in a second. So lease expense, when it's operating lease, straight line. So what do we put in our numerator? We add up all our lease payments over the term. Add it all up. Add it all up. Put that in your numerator. Okay, then you're going to divide that by the lease term, and there it becomes your straight line lease expense. Each period over lease term. Okay, each and every period over the lease term. Okay, don't worry about anything else just yet, but that's it. Operating lease, add up all your payments in the numerator, divided by the lease term. There's your straight line lease expense each and every period over the term of that lease. All righty, next issue. You ready? That lease expense is made up of two components. You ready? We're going to debit our lease expense, but we're going to calculate what's called our accreted interest. What the hell is that? You're not recording interest expense. Do not record interest expense. Do not record interest expense, okay? You're calculating, but you're not recording what's called accreted interest. Take the beginning carrying value of that liability, okay, beginning of that period, times the rate in the lease, times the number of months over 12. Okay, you're going to credit your lease liability for that amount. Okay. Next step. What's our plug figure? Our right of use asset. You then credit your right of use asset. That is your plug figure. So again, we debit lease expense. Straight line, that number. We're going to credit our lease obligation, beginning carrying value of the liability times the rate times the number of months over 12. Then you're going to credit right of use asset, and folks, that'll be your plug figure. That is the reduction of the asset. That is the equivalent of the asset amortization. Do not record amortization though. You're calculating it, but under an operating lease, our debit is to lease expense. There is no interest expense. We are calculating the equivalent of interest expense. We are calculating the equivalent of amortization, but I'm not recording any amortization expense, okay? Just remember, we debit lease expense, straight line, credit your lease obligation, credit your right of use asset. That's journal entry 1 of 2. What's journal entry 2 of 2? Then you will debit your lease obligation and credit your cash payment. And that cash payment is all what? Financing outflow on the statement of cash flow. Let's go. All right, right of use asset may or may not be equal to the present value of your lease obligation if right of use asset does not equal the present value of lease obligation. Plug cash, debit or credit to balance that journal entry. That's all. All righty. So how do we get the right of use asset? How do we get the right of use asset? What do we start with? The present value of the lease obligation. That's our starting point. Plus and minus other stuff. What's the other stuff? You might have some lease costs because there's always a friggin' lawyer looking to get paid. Always. Maybe there's some broker out there trying to get a commission. Maybe you prepaid some lease payments. But check this out. This reduces, don't add it, a lease signing bonus, a lease incentive. Hey, some free rent. All right, so some lease incentive, free rent. So let's just pretend. You ready? Let's just pretend that the right of use asset, we add all that stuff up, and let's pretend we get 55, okay? But let's say the present value of the lease obligation, for example, is only 50. You'll debit your right of use asset, 55. You'll credit the present value of the lease obligation, 50. Confidence building question. What do we do to make this journal entry balance? Even somebody like me with a small brain, I'm going to credit my cash to make this balance. I will credit my cash. That is my plug figure. And I'll credit cash for 5. That's it. All right. So the right of use asset may or may not be equal to the present value of the lease obligation. It all depends upon whether there's that other stuff. Indirect costs make the right of use asset go up. We capitalize that. Prepaid lease payments, we capitalize that. Lease incentives, a lease signing bonus. Okay, that lease signing bonus, that will reduce our right of use asset. Okay, no big deal. Now, right of use asset is going to be amortized over the term of the lease. Why do we amortize it? Even though operating lease, even though we're not recording amortization expense, we're still spreading out the cost over the period benefited. Why would we do that? Why? What principle says? Matching. That lease is going to benefit, help us generate revenue beyond the current period. Okay, so we're gonna calculate it, but not record it. So with an operating lease, you calculate, but do not record amortization or interest expense. You calculate it, but you don't actually record it. We use different journal entries. Okay, your lease liability. Ready? Present value of that lease obligation. Now, it's an annuity. Payments come at the end of each period. We need the present value factor of an ordinary annuity. Multiple payments of an equal amount, an annuity, but the first payment happens now. Then we need the present value factor of an annuity due. First payment happens immediately. But then we might have to add to that some other stuff. What might be that other stuff? Present value of any guaranteed salvage value. Okay, now you need the present value factor of a one-time future payment. All right, so the present value of one-time future payment, tell me the number of payments, how long into the future, and then tell me the rate on the lease. Okay, you have to find the present value. That's not multiple payments. That's a one-time, that guaranteed salvage value. All right, so if you've got guaranteed salvage value, you got to add it in. But you find the present value of that one-time future payment by using the present value factor of 1. Okay, so initially we record the present value of the lease payments. That is true. Operating lease and financing lease. Now, each period, if it's an operating lease, 2 journal entries. We've got 1 of 2, 2 of 2. Okay, we debit our lease expense, credit our lease liability, plug our right of use asset. Journal entry number 2, we debit the lease obligation, credit our cash payment. Okay, so those 2 journal entries. At the end of the lease, your lease liability is 0. And that's true for both an operating lease and a capital lease. True for both operating lease and financing lease. Sometimes a financing lease is called a capitalized lease, whatever. All right. Operating lease components, not to be memorized, folks. This is to be understood. What are we doing this from? The perspective of the lessee. Operating lease, no interest or amortization expense. Just straight line lease expense. That's it. All right, so we're going to record the right of use asset and the lease liability. Okay, prepaid rent, prepaid asset. That's going to make the right of use asset go in what direction? Up. A refundable security deposit. Hey, we haven't talked about that yet. Well, what are we going to do? Debit a long-term receivable. We'll get that back at the end of the lease so long as you don't mess up the place. Credit cash. Someday you get it back, you'll debit your cash, credit the receivable. You make an improvement, and many times you get, big stores, it takes them 3, 6, 9 months to build out. Any leasehold improvements get capitalized and amortized over the shorter of the remaining lease term or the useful life. Why the shorter term? Because the lower the denominator, the bigger the expense, okay? Rule of conservatism. That's why we use the shorter of those 2, okay, for any leasehold improvements. And then if you've got an operating lease, what do we got? Straight line rent expense, but we call it lease expense. What's journal entry 1 of 2 again? How good's your short-term memory? We debit lease expense, straight line, total payments divided by the term of the lease. We're going to credit that lease obligation, carrying value of the lease times the rate times the number of months over 12. Then you're going to credit your right of use asset, and that will be your plug figure. We're reducing the asset. That's spreading out the cost over the periods benefited. Journal entry 2 of 2, we debit the lease obligation, credit the payment. That's it. Operating lease. Let's go. We record that expense, though, uniformly over the lease term, not when the cash is paid. Not when the cash is paid. Okay. And when do we start recording the lease? Excuse me. When do we start recording the lease expense? As soon as you get what? Control. Okay. As soon as you get control. All righty. We got to record it uniformly. Thus, it's called straight line. All righty, folks. So the way our course works, we teach it as though you've never seen it before. Because I don't know, did your school teach it? If they did they teach it well? Do you remember it? We don't presume you remembered it. We don't presume you got an A. Shit, for the most part, I'll presume you got a C. Bring me to C, I'll get you to P and the A. So now let's apply it. You ready? Here's an example. How do we do an operating lease? All right. Determine when the recognition of the rent expense for the new office building, when should that begin? What am I thinking? As soon as we get what? Control. I read the question stem first. As soon as we get control. All right, on January 1, we entered into an operating lease. So 0 for 5. We are not a special snob. As soon as I see operating, I think straight line. What are we recording? Lease expense. No amortization, no rent. All right, for the office space, and we receive control. When did we get control? January 1. All right, so that's when the lease expense begins. All right, as soon as we get control of the property to make improvements. The fact that we're altering it and not generating revenue, I don't care. Doesn't matter. Staff doesn't move into the property till May 1st. I don't care. All of that is distractor information. Rent expense begins when we get control. And when did we get control? January 1. The fact that we're making leasehold improvements at that time, I'll capitalize it, I'll amortize it over the term of the lease. But I'm nonetheless starting my rent expense January 1. So rent expense is going to begin to accrue on January 1. All righty. Now, when do we start making payments? Payments begin when? July 1. All right. So from January 1 through June 30, what are we going to have? Rent expense. 6 months worth. Credit, rent payable. Even though we're not making any payments, we're accrual basis, not cash basis. All right. How do we get the rent expense again? Total payments divided by the term of that lease. There is your straight line rent expense, your lease expense. Okay, rent, lease expense, same thing. July 1 is when we start to make payments. Then you will start to debit your rent payable. You will credit now your rent expense. Then you'll credit your cash payment. Okay. So let's take a look at some math now. And this is and I should actually clarify here. Let's see an example with numbers, and then we'll crank it out. You ready? When does the company have control over the space? January. Thus, rent expense begins January 1 when we get control. Okay, the fact that we're not making a cash payment till July 1, okay, we still record rent expense January 1 through June 30. All righty. July 1 is when we start making payments. And how often are we making payments? Monthly. All righty. So at the end of July, we will record more rent expense, etc. And we're going to see an example of that. Okay, what do we do with the leasehold improvements in March? We capitalize and amortize. Over what period? Shorter of whatever the useful life is or the remaining term. Why the shorter of? Rule of conservatism. The lower the denominator, the bigger the expense. Okay, so whatever the useful life is of that leasehold improvement or the remaining term of the lease. We capitalize and amortize. Staff moves into the office. Distractor information. We could care less. Distractor. Doesn't matter. Irrelevant. Next thing they tell us. July 1, we start making payments. Okay, so that will reduce some of that rent payable we've been accruing. January 1 through June 30, we're debiting rent or lease expense, crediting rent payable, lease payable. Starting July 1, we'll debit that rent payable, credit cash. Okay. That rent payable will go down, but nonetheless, January 1 through July 30th. Okay. July 1 through the end of the lease. July 1 through the end of the lease, you'll have your remaining payments. Okay. You'll record your lease expense. Let's just put down, sorry about that, folks. For the remaining term of lease, you'll have your lease expense, straight line, you'll credit your payment, and then your rent payable, that will be your plug figure. Okay, and your lease expense continues, straight line, uniform, total number of payments divided by the term of the lease. All right. So you've got to understand the sequence of events. January 1, though, that's when we get control. That's when we start accruing for the rent expense. Okay, so you recognize that expense as soon as we get control, even if not generating revenue yet. Doesn't matter. Even though you're doing the leasehold improvements. Okay, so that's irrelevant. Next, let's take a look at an example. Excellent example. You ready? First thing I want to do with every single lease question on the exam is see, am I a special kind of snob so that I know, is it an operating lease or a financing lease? What am I recording? So the term of my lease is 5 years. Okay, no renewal option. So there's no bargain purchase option. Okay, let's see. For office equipment, January 1, year 1. Useful life is 10 years. 5 divided by 10. That's only 50%. We just failed the 75% test. That is less than 75. There's the S. So we failed that test. The client has an incremental borrowing rate of 6%, and the payments are $10,000 per year due at the end of each year. So I need my present value factor for an ordinary annuity. Now, number one, I'm looking for the rate in the lease. If they don't give me that, then what do I use? The incremental borrowing rate. Okay, so I see an incremental borrowing rate of 6%. So I need the present value factor of an ordinary annuity for N equal to 5 payments at a rate of 6%. Okay, they tell me as an inducement to enter into the agreement, the client has been offered the first 6 months free and a $1,000 signing bonus. Okay, so the first 6 months are free. So what? We're still going to be recording rent expense. It doesn't matter. Okay, and we get a $1,000 signing bonus. Well, that's cool. That signing bonus we could use towards making improvements. But right of use asset, due to that signing bonus, that reduces the right of use asset. Okay, now the other thing is, first 6 months, well, if it's $10,000 per year, then 6 months must be how much? $5,000 rent free. $5,000 is going to be rent free. That's one time. Okay, that's one time. First 6 months rent free. If it's $10,000 a year, then 6 months, $5,000. Okay, that's one time. That's going to reduce the present value of my lease obligation. Okay, present value of my lease obligation. Okay, The lessee has incurred $1,000 of indirect costs. That's going to make your right of use asset go up. Those indirect costs, the commissions, the legal fees, all that kind of stuff. The present value factor for a lump sum at 6% for 1 year is 0.943. Stop right there. The one-time free rent, $5,000. It's one time, so we need the present value factor of a one-time payment. 5,000 times 0.943. That works out to be 4,715. That is going to reduce the present value of your lease obligation. That's going to make it go down. Okay, one-time savings. All right, $5,000. They tell us the present value factor of an ordinary annuity. Why is it ordinary? Because the payments are coming when? At the end of each period. At 6% for 5 years. Present value factor of that ordinary annuity, 4.212. What is my payment each and every year? $10,000 is my payment. That $10,000 payment, that's multiple equal payments. That is the definition of an annuity. Multiplied by the present value factor of an ordinary annuity. This was the present value of 1. These are multiple payments of $10,000. That works out to be 42,000, 4.212, 42,120. That makes the present value of the lease obligation go up. Net it out. What is the present value of your lease obligation? $37,405. $37,405. The present value of free rent. Present value of free rent reduces the present value of your lease obligation. Thus, it's going to make your right of use asset lower than it would have been otherwise. Okay. So what else do we got? Payment schedule is as follows. First year, $5,000, and we have 4 payments. So total payments, $45,000. Total payments, add it all up, $45,000 divided by the term of the lease, 5 years. What's our straight line rent expense? $9,000. Now let me just check. You ready? Did we meet the end test? The present value of that lease obligation, is that greater than or equal to 90% of the fair market value? There's no indication of what the fair market value is. So absent that information, the answer is no. Are we getting ownership? Nope. Any mention of a bargain purchase option? As a matter of fact, no bargain purchase option, no renewal option. Did it say anything about it being specially manufactured for this lessee? Nope. So we're 0 for 5 operating lease. So we need that straight line rent expense. Total payments, add it all up, $45,000. Divided by the term of the lease, 5 years, present value of that lease obligation, $37,405. Our annual rent expense, $9,000. Okay, so ready? 45,000 divided by 5 years. That's your lease term. $9,000 straight line, because why? We're an operating lease. We were 0 for 5 with the special snob. Okay, so ready? At lease inception, financing lease and operating lease, what do we have to do? Debit our right of use asset. I don't know that number yet, but I do know the present value of my lease obligation, $37,405. That we know. That was the present value of the $5,000 free, okay, one time, present value factor of 1, plus the present value factor of an ordinary annuity times the $10,000 annual payment. Sum of the two, $37,405. What I don't know yet is the right of use asset. Don't know it yet. We're going to solve for that next. Okay, so next up, right of use asset. You ready? What do we start with? Remember, the right of use asset may or may not equal the present value of the lease obligation. So we know the present value of the lease obligation is our starting point, plus or minus other stuff. Okay. Was there any lease payments made at or before? Any prepaid? Zero. That didn't apply. Were there any lease incentives? A signing bonus? There sure was, $1,000. That reduces it, a minus. Were there any indirect costs, legal fees, commissions? There sure was. Now, in this question, that happened to offset. But what if that doesn't offset? Okay, so obviously we're going to debit the right of use asset, credit the lease obligation, debit right of use asset, $37,405, credit your lease obligation, $37,405. Okay, but what if they were not the same? What if the lease bonus were $1,200 greater than the cost of $1,000? Okay, so what if we subtracted $1,200 instead of $1,000? Then we would be debiting our right of use asset. If we subtracted an extra $200, that would be $37,205. $37,205 if we subtracted $1,200 instead. We would credit our lease obligation, though, still for $37,405, no change. So what would we do? Debit cash, $200. That would be your plug figure to balance this, okay? Now, what if I change the facts again? And what if the bonus, let's say, is $700 less than the cost of $1,000? So what if we subtract only $700 instead? Then your right of use asset would be higher. If we subtract a smaller number, your right of use asset, instead of being $37,405, it would be $37,705. Okay, we would still credit our lease obligation, no change. $37,405, sorry about that, $37,405. And then what do we do to make our journal entry balance? You plug cash, $300. Okay, so it just so happened in this case that the lease bonus, the signing bonus, offset the cost. But if that's not the case, no worries. We just plug cash to make that journal entry balance. Okay, so whether it's a financing lease or operating lease, exact same journal entry at initiation. So long as it's relatively long, right? Greater than or equal to a year. So that's the general rule. We're going to record the asset and the liability. Do not memorize. Use T accounts. Okay? Do not memorize. Okay? These amortization schedules. No. Let me show you what we're going to do. You ready? Let me insert a slide here. Nice and pretty. I just need a blank slide. There we go. Ready? So let me show you how we're going to do it. Ready? Payment number 1 at the end of year 1. Remember, we got 6 months free. So 10,000 minus 5,000. At the end of year 1, we have a $5,000 payment. Journal entry 1 of 2, operating lease. We're going to debit our lease expense, straight line, $45,000 divided by 5 years, $9,000, independent of the cash paid. I'm going to credit my lease liability. You ready? Beginning carrying value of your liability. Beginning carrying value of our liability, $37,405. Times our rate, 6%. I know this seems silly, but this is at the end of year 1, okay, at December 31st, year 1. All right, entire year. That's $2,244. $2,244. That makes your liability go up. Then we credit our right of use asset. That is your plug figure. This is the calculation backing into implicitly the amortization. To make our journal entry balance, $2,244, 9,000 minus the 2,244, $67.56. Okay, journal entry 2 of 2. Debit your lease liability, $5,000, credit cash. Remember, this is payment number 1 only, $5,000, because we had 6 months free. Okay, now do your T accounts for me. You ready? Your liability T account. No amortization schedules. You don't need to do that. Makes it harder than it is. What was our beginning? $37,405. From journal entry number 1 of 2, what made it go up? $2,244. From journal entry 2 of 2, what made it go down? $5,000. So what is our ending lease liability? Our ending, $34,649. $34,649. Okay, our right of use asset started at what amount? $37,405. Per journal entry 1 of 2, we credited it. Per journal entry 1 of 2, $6,756. That's our implicit amortization. What's our asset now? $30,649. Okay, let's do another year because we love this stuff. And I know, my friends at UWorld, we all love this. Megan, Julie behind the scenes, she's like the Wizard of Oz back there. Charlotte, they're hoping I go to 7:30, 8 o'clock tonight. All right, ready?
I mean, I book extra time for you, Pete. I'm like, you know, we're just going to go. I love leases so much, and then I'm just super excited to hang out and talk leases with you.
Let's go. Payment number 2. End of year 2. She's Megan CPAs, man. That's what Megan is doing. She's making them. End of year 2, $10,000. Remember, end of year 2, we make a $10,000 payment. Okay, journal entry 1 of 2 at the end of year 2. You ready? Lease expense, straight line, no change. Every single year, straight line, $9,000. Agreed? Credit your lease liability. Now, I need my beginning carrying value of that liability. You all see this number, $34,649. $34,649 times the rate, 6%. This is an entire year. I know it seems silly, but just as a reminder, an entire year. $2,079. Credit your right of use asset. That is your plug figure. The implicit amortization, $9,000 minus $2,079. Right of use asset is gets credited for $6,921. Journal entry 2 of 2. Debit your lease liability, $10,000. Credit payment number 2, cash, $10,000. Now, your lease obligation, where was it? It was $34,649, right? It was $34,649. Your lease liability, $34,649. We increased it. Man, that's an ugly $34,649. $34,649. Journal entry 1 of 2 increased it by $2,079. Journal entry 2 of 2 reduced it by $10,000. So at the end of year 2, what is our lease obligation? $26,728 at the end of year 2. Okay, December 31st, year 2, that's now your lease obligation. Right of use asset. What was it? It was $30,649, right? $30,649. Come on, pen. Sorry about that. It was $30,649. Journal entry 1 of 2. We reduced it by $6,921. This $6,921. So now it's $23,729. Sorry about that. $23,729 at December 31st, year 2. All right. T accounts. T accounts are your friend. So when you do task-based simulations, I call it legalized cheating. If you see it's an operating lease and you see you got to do journal entries, man, long before I'm reading the facts and getting bogged down, if it's an operating lease, and they tell me that, or I'm remembering my rules, I'm putting down my journal entries. No numbers yet. I'll plug my numbers in as I go, but I'm getting those journal entries down. Okay, if it's a financing lease, I'm debiting amortization expense, interest expense instead. Operating lease, straight line lease expense, right? We set it up in advance. Then when you read your facts and open your exhibits, you're plugging in numbers. But you're not memorizing. No, the right of use asset schedule, do not. T accounts are your friend, All right, you're not memorizing any of that stuff. Come on, man. So if you had to combine it all into one journal entry, lease expense, operating lease, straight line, 45,000, 5 plus 10 plus 10 plus 10 plus 10 divided by that 5-year term. There you go. Lease liability, $2,756. Where did we get our debit to 2,000? That's part. See, that's why I don't like this. I do that in journal entry. I do it separately. I do them one at a time. So I do it, debit my lease expense, 9,000, right? So I do it in 2 steps. Where did I get my credits from? My end of year 1, that lease liability, beginning carrying value, times the rate, times the number of months over 12. I got that to be 2,244. This is year 1. Then I credit my right of use asset, and that was 6,756. You see, when you try to do it in one, that's where you could start having issues. This is journal entry 1 of 2, journal entry 2 of 2. Now you're debiting your lease obligation for your payment of 5,000, crediting cash for 5,000. Now look, if they set it up on the exam such that you've got to do it in one big ass journal entry, and that is the official accounting term, one big ass journal entry, well then obviously you've got a credit to your lease obligation, you've got a debit. Okay, so that's the difference. That's where they get the 2,756. If you take the 5,000 debit minus the 2,244, there you go, 2,756. But see, that's like memorizing stuff, and I don't like that stuff, man. 2 journal entries. 2 journal entries is the way to go. Right of use asset, 6,756. Obviously, our right of use asset, when you do your 1 journal entry, that was your lease expense. Lease expense, 9,000. We credit our lease obligation for the implicit interest, which we just said was our lease 2,244, and then our right of use asset, that was the difference, our plug figure, the 9,000 minus the 2,244, 6,756. Then journal entry 2 of 2, we credit debit our lease obligation, credit cash, $5,000, okay? And obviously, it's very easy to combine the journal entries. All right, there's your cash payment of $5,000 on payment number 1. You got it? All right, I know you do. And then year 2, we've already done, so that's all of year 2. We're using T accounts, and that's the way to go. Charlotte, are you spinning a web? What are you doing, Charlotte?
I am not spinning a web. I'm laughing at your, I'm learning about leases, and I liked the SNOB acronym.
Yeah, don't you like that? See, I like to mess with it. I make up my own. But go ahead, let's go. I'm sorry, I'm interrupting you. Go ahead, you got it. You got the floor.
No, you're perfect. I have the pleasure of being kind of our intermission here as we take a break with Peter teaching leases. So for those of you that are joining us today that have not enrolled in UWorld yet, welcome. We're here to help ensure that you pass not only the FAR section with leases, but the entire CPA exam at large. So you'll see here, I'm going to share a couple slides a little bit about uniquely how we do things here at UWorld. Specifically, if you remember at the beginning, I talked about our 90% CPA exam pass rate. Really exciting for the 2026 UWorld CPA review course. Over the last few years, we've significantly invested in making sure that our students and our candidates have the absolute best experience within the course. So you'll see here, all of our study materials have been updated for the new, for the current exam. For those of you getting ready to sit for Reg and TCP later this year, One Big Beautiful Bill Act, we are busy updating all of those materials, and those will be ready for you soon as well. Everything is clearly mapped to the AICPA blueprints. You've all seen that as an example tonight as Peter has been speaking about leases. Expert team of accounting educators, I'll show you here in a moment. And then of course that proven 90% CPA exam pass rate. You'll see on the right at UWorld, we're proud to do things differently over the past few years. Some of that investment in our course for all of you is included acquiring Roger CPA Review. So Roger Phillip, great instructor in CPA Review Prep, the Wiley Efficient Learning. So if you have any colleagues or other students that passed with Wiley CPA Review Prep, and then of course, Mr. Peter Olinto joining our team as well a few years ago. So here's an example. You'll see a picture of Peter and Roger together, quite the powerhouse. Some of the absolute most favorite instructors leading within CPA Review. I know you and Roger go way back, Peter, enjoying each other's different types of instructions.
Chat GPT says Roger is the best. Number 1. Megan is number 2, and I'm number 3. All right, so that's right.
You know what though? You two are going to retire way before I do, so I'm going to have time to take over.
She's saying you're old, Peter. She's saying you're old.
Oh, we are both OLDY. We ain't got no alibi. We old age. Let's go.
I'd say as you go to that next slide on Meet Your Instructors, I'd say you're not old. You're proven. You're proven there. So you'll see Roger and Peter up at our top left, right next to Megan, so quite the powerhouse, but also many other great instructors, leading instructors from a number of programs, some of the best within the industry, including I'll give a shout out to Greg and Suzanne, both leading authors on the Wiley Tax textbook, including I will also give a shout out to Dr. Marcus Burke down there, also has his CISA, heavily featured, for example, in our ISC section as one example. So quite the team there. Lots of doctors, Peter. You're surrounded by a lot of doctors.
Damn.
I was gonna say you're missing Jesse and Jeannie. Like we got a lot of us floating around here.
Yeah. But most importantly, we all have worked in public accounting and brings a lot of their real life examples to the course to keep our students not only engaged, but also entertained as you're studying, for example, leases, which is a very difficult concept for most candidates. So next slide, let's show about, so with this particular area, so many candidates come into UWorld, and as you heard Peter mention, we don't know kind of what kind of campus you came from or what program you came from as far as classes that you hadn't had. But one of the things that we do know is that everyone needs a little extra help with the planning and locking into a study schedule, right? It's not going to do you any good if you're not actually logging in and studying for the exam. So what we provide at UWorld is a study planner that is unique to you, your life, and your schedule. So what you do, and this is all available on our free trial for those of you that might want to test it out, is that you come in to the study planner and you put what day you want to start studying and basically what your goal as far as your exam date goes. So once you have those two things put in, and as Peter's writing right here, one-to-one onboarding. So we have a whole team here that helps do this advising. My favorite question a lot of candidates will say is, how much time is this going to take me? And I say, well, it depends. Let's open up your study planner, see what your life actually looks like and what you can commit to, and let's see what your actual exam plan is going to look like. So you'll see here, I can see Peter, he's kind of leading me here with what kind of student were you, A, B, C student, what electives did you take? I'll point out, for example, government nonprofit. Some schools, government nonprofits required, some it's an elective. We don't know kind of where you're coming from on that. And so it's allows us to help customize it even further. So you are going to put in your start date and your end goal date to sit for the exam. Then the next slide, Peter will go ahead and switch it there, is on the next slide, you're going to tell us how much time you have. This is where you have to have a truthful, honest conversation with yourself and what your life looks like. How many hours can you give us a week to study for the CPA exam? You're going to put that into the customized study planner. At minimum, we're always going to recommend at least 1 4-hour block. Why? CPA exam's a 4-hour marathon. So we want to get you trained up with that, at least 1 4-hour exam block. From there, you're going to let us know, you're going to let the system know, what do you have? Do you have 1 hour every day, 2 hours, 3 hours, 4 hours? You're basically going to put in that study time or your study wish list, and the system will give you go, no go. When you get the go and the thumbs up, it's going to lock you in, and every day, based on the amount of time that you said you have to study, you're going to get those assignments, the question sets, the lectures, the ebook reading. It is a custom syllabus for you with your exam day goals in mind. Okay, so as I mentioned, that is something you could definitely check out with our free trial if you have not already. So the next slide here for me, Pete, is so that study planner is going to organize all the material for you. So as Peter mentioned, that's going to include some of the lecture videos taught by Peter and our other instructors. It's also going to include some of the textbook readings. So we do offer ebook and print. What you'll see here is every single component of the UWorld course is mapped to the CPA exam blueprints. If it's not on the blueprints, it's not going to be covered in UWorld because we're not going to spend time covering something that's no longer even tested on the exam. In this example, what you'll see is every time you start a lecture, as you've seen from Peter, our instructors are going to point out what is the representative task that you are needing to know, and then how are you going to be tested on the exam. You'll also see that defined in the textbook, and you'll also see it within the question bank. So again, it's a one-to-one. If it's heavily covered in UWorld, it's going to be heavily tested on the exam, and vice versa as you go through the materials. Next slide for me, Pete, is going to be a question example. So you're actually getting a really intimate experience here, seeing how the questions are working as Peter's going through the instruction. But a high level with UWorld, this is a real game changer for our candidates. So you'll see here, as you're working through the questions, first thing, you're going to get immediate performance feedback. So as you select your answer, what percentage of other UWorlders also selected that same answer? It's going to help you get a quick temperature check on how difficult this potential question is. From there, you'll see on the right a very thorough answer explanation. So we're going to start with a visual, graph, chart, really important for our visual learners. Then an in-depth answer explanation. We are not cutting corners here. These take a long time. I know Megan writes a number of our answer explanations along with the rest of our content team, but we're going to reinforce why the correct answer is correct. And then very important, a UWorld differentiator for our learners, you're also going to get why the incorrect answers are wrong. So again, if you get the answer right, great, affirm yourself, pat on the back, I got it right. But what's really important is when you get it wrong. And if you keep getting it wrong, we need to correct that so that you don't keep applying that wrong knowledge as you move forward. So you're going to get also why the wrong answers are incorrect. You'll see there at the bottom, you'll get a key takeaway. That's a summary of the entire answer explanation. That blueprint, as mentioned, every single component is going to point back to the big AICPA blueprints. And then at the very bottom there, you'll see every single answer explanation is connected to one of our lecture videos. So if you're watching the lecture video, for example, with Peter, then you go practice some of the questions and you get stuck. You can easily link into that lecture video, go back and watch that video, and then resume and jump back into the question. Something else I'll also point out on this one before we move on is we also just recently launched You Ask. So You Ask is our AI chatbot within the UWorld course. You can ask it to re-help you with the answer explanation. What's really important about You Ask is it's all going to be sourced within the UWorld content. So you don't have to worry about something wrong coming like a chat GPT. It's a brand new feature that we recently launched that many of our candidates and students are really enjoying. So whether it's the thorough answer explanation, you rewatch the video, you're using You Ask, we're going to ensure that you understand these concepts as you're going through the questions. AI Megan, you're going to be the new chatbot moving forward.
I was going to say, it's almost as good as having Peter Olinto there. You're studying and you're like, man, I wish Pete was here to explain this to me. And I'm not going to give you his cell phone number, but at least you can ask You Ask, right?
You can always ask You Ask.
My cell phone
Peter, Megan's not going to have time to be the AI because, as you see here, Megan's featured in our TBS Mastery videos. So with the TBS Mastery videos, these are a great asset for our candidates. What's really important here is that we understand, multiple choice questions. We got to teach you the multiple choice questions, but the real killers can be the task-based simulations. And we listen to our candidates. Hey, We want a little more help. We want some more resources. And so what we are have been putting into the course are these TBS mastery videos. So you have two key assets for the TBS in addition to the thorough answer explanation. One is we provide in our study resources strategy walkthrough videos. So what types of TBS you're going to see in general. So for example, you're in FAR, you're going to have a document review simulation in general. When you're in FAR and you see a document review simulation, this is how you should approach that question. On the other side, we also have TBS mastery videos in our explanations. So these are one-to-one. So in that example, you might have Megan teaching you specifically, this TBS is a document review. What are they asking you? What do you need to know and how to go through it? So it's very similar to kind of what you're receiving tonight with Leases from Peter. But for example, Megan has featured these TBS mastery videos and our students are absolutely loving them. So great addition to help you tackle those TBS. Also, Pete had mentioned live CPA boot camp. So this is just a sample of a live boot camp. These are offered throughout the year from various instructors, including Peter, especially highlighted in FAR. This is where we're going to take the highly tested exam topics. They're going to be included. You can sign up. This provides a great live element of the UWorld course. So you're watching the videos, you're practicing the questions, you're really understanding the material. However, you see a live boot camp coming up, statement of cash flows, I'm going to jump in and I'm going to watch with Peter in addition to some other instructors. Next slide for me, Pete. It's the biggie, Smart Path. This is the big game changer, especially for UWorld candidates. So Smart Path, as you're working through the questions and as you're going through the concepts, Smart Path is going to be constantly reading your data. So as you'll see here, for every chapter, this is going to be with audit basics and engagement planning. We're going to give you two targets for that chapter, your target score or your proficiency, and then the right volume. So you're going to have what should your score be and what's the proper volume you should practice on that particular chapter. What is that telling you? You do not have to be 100% correct on 100% of everything, and you should not have to be working 100% of the questions over and over and over again. You will hit a point of diminishing returns. Those targets have been set by other candidates in UWorld that have already passed the CPA exam. We take that same pathway that they took, we serve them up to you. You aim to hit both those targets. Why is that so important? Because candidates in UWorld that hit their Smart Path targets, that's where we're going to have over a 90% CPA exam pass rate. You're going to pass that section. So it's absolutely a game changer for our candidates. And as you can imagine, as myself and Megan and others coach candidates, we're always talking about, let's look at your Smart Path. So it's definitely included and a key feature within the UWorld course. The next, just a couple more slides with me before we turn it back over to Leases. If you wouldn't mind going to the next slide for me, Pete. We're also right here, we're going to have exam support with mock sims and exam sims. So it's a 4-hour marathon. We got to get you ready for the marathon. You have unlimited practice on the exam simulator. That's going to pull from the question bank. It's going to serve you up a 4-hour real deal experience. Testlet 1, 2, 3, 4, 5. You could practice that as much as you'd like throughout the course. In addition, we're going to have mock exams. So you're going to see here 2 per core, 1 for discipline. Mock exams, they're a one shot each time. The reason why, brand new questions you have never seen before. It's going to actually give you the truest mock exam of experience to really make sure that you're ready for exam day, including some feedback on some of those strengths and weaknesses. Next slide, we want to celebrate with you. So, right, that's the whole goal here. We want to get you past all 4 parts on the CPA exam. We want to help you achieve that 90% pass rate. You'll see here one of our many celebratory stories with Kayla. How did they do that, passing the CPA exam? As I mentioned, hit Smart Path targets, working that question bank, practicing at least 100 practice quizzes, and studying for 60 days. So as Peter mentioned, slow and steady, what we're trying to say there, this is a marathon. You're not going to just decide, I'm going to sit for the CPA exam tomorrow and try to cram this one in. The way you're going to pass the exam is slow and steady, hitting your Smart Path targets and utilizing the course for all it's worth and all that is provided. Last slide for me, Pete, and then I'm going to turn it back to you. For those of you, if you have not joined in UWorld, we definitely want to encourage you. Again, try out that free trial. You are getting a premium free trial tonight with Peter. But it's a great opportunity to enroll in the UWorld Elite Unlimited course at a unique discount. You'll see their code is FAR Lecture. You can scan that QR code. Great opportunity to get our premium package with the Elite Unlimited course. It's going to include everything that I mentioned plus more with an unlimited subscription. So we are going to see you all the way through getting those 4 passing scores on your way to becoming a CPA. So Peter, I'm going to now say, let's go. I can't say it the same way you did. I'm not even going to try, and I'm going to turn it back over to you to continue with leases tonight.
Let's go. All right, listen, you want to get reimbursed or you want a direct bill? QPERKSON at UWorld. So if you want to know if your firm, do they reimburse or is it a direct bill? Contact my buddy Quinn at QPerkson, PERKSON at UWorld.com. And if your firm is currently using that old course that used to be good back in the day, but there's a new sheriff in town, you tell them, hey, listen, we want you to have choice. Let them stay. Let them stay. But you need UWorld as a choice because we want you to put them side by side. So your firm should be like lots of others that are giving their employees choice. All right. This way you all can determine what's best for you. QPerkson at UWorld.com. All right. So second half, actually financing leases. We've discussed a lot of the issues here with a financing lease. How do we know you're a special kind of snob and we only need to meet any one of the 5, not all 5? Okay. Remember, step number 1, whether it's a financing lease or operating lease, what are we going to debit? Your right of use asset. And we are going to credit the present value of your lease obligation, whether it's an operating lease or a financing lease. And remember, if those two are not the same, let's say the cash bonus is greater than your costs, then what are we going to do to make our journal entry balance? You'll debit cash. What if it turns out the cash bonus you receive is less than your cost? Then what will we do? Credit cash to make this journal entry balance exactly the same, whether it's a financing lease or an operating lease, okay? But then subsequently things change, all right? Once you've determined subsequent journal entries, now you've determined that, hey, it's a financing lease. All right, what we want to do now is that cash payment, we got to allocate between principal reduction and interest expense. So you're going to take the beginning carrying value of that liability. You're going to multiply it by your rate and then just watch your term, year number 1 especially. How much is my interest expense? All right, you're actually going to record interest expense. And folks, on your statement of cash flow, that's an operating outflow. Then you will take that payment, back out what you just recorded for interest expense. And what's the rest going to be? A reduction to your lease liability. That will be, by the way, a financing outflow on your statement of cash flow. Okay? So with a financing lease, what are we recording? Interest expense and amortization expense. 2 expenses. Okay, so we'll record our interest expense, but we're also going to record amortization. So how do we record amortization? Tell me what that right of use asset is. And then you're going to divide it over the proper number of periods, which I will show you in just a second. You will then debit amortization expense, credit your right of use asset. Okay, debit your amortization expense, credit your right of use asset. Now the question becomes, what are you dividing by? Well, it depends how you met the qualification to become a financing lease. If you met the S or the N test, the 75% test or the 90% test, you're going to divide by the shorter of the term of the lease or useful life. The shorter of useful life or the term. Okay, but if it's special, or you met the O, you get ownership, or you have a bargain purchase option, then you're going to divide by useful life, because it's as if the whole thing belongs to you. You've got ownership at the end of the lease. You got a bargain purchase option. You're definitely going to buy it because it's so cheap or was specially made for you. You'll divide by useful life. Okay, so that's it, man. Let's do some examples. Let's jump right into the math. Ready? We love the math, so let's do it. So, financing lease, lessee accounting. Don't forget in FAR. All right, I prefer 2 journal entries. You know me. Okay, financing lease. Just make sure you meet any one of those, and then you will do your journal entries for a financing lease. So here we go. They tell us, determine if Mitten, why didn't they call it Megan, should classify the lease as operating or financing. So if that's the question, then I write down, is it specially manufactured for me? Do I meet the 75, the 90, the ownership, or the bargain purchase? By the way, if you meet the O or the B, that supersedes you might meet multiple. You only need to meet 1 of 5. But if you meet more than 1 of 5, the O and the B dominate, okay? The O and the B will dominate, as you'll see. All right, so we're going to continue with our fact pattern. So Mitten has signed a 5-year lease for office equipment on January 1, year 1. The client has an incremental borrowing rate of 6%. If they don't give you the rate implicit in the lease, then we use the incremental borrowing rate. Payments are $10,000 per year, so that's an annuity. So I'm going to need my present value factor for an annuity. When is it coming? End of each year. Present value factor for an ordinary annuity, N equal to 5, rate 6%. As an inducement to enter to the agreement, the client has been offered 6 months free and a $1,000 signing bonus. So the 6 months free, that's a value of $5,000. I need the present value factor of a one-time savings. One-time savings. 5 years, discount rate, 6%. Okay, and then you're getting a $1,000 signing bonus. That'll reduce your right of use asset. We got indirect costs, the lawyer, the commissions. That'll make your right of use asset go up. The present value factor for a lump sum at 6%. Present value factor, one-time payment, 0.943. Present value factor of an ordinary annuity. If they give you an annuity due, it's distractor information. Okay, so if it's an operating lease, no interest, no amortization. If it's a financing lease, then we're going to have to record interest expense as well as amortization expense. All righty, so let's see. Operating or financing lease. So January 1, let's see what we got. So first of all, step 1, operating lease or financing lease. I've got the $10,000 payment coming at the end of each period. So I'm going to multiply that by the present value factor of an ordinary annuity, 4.212. So that works out to be $42,120. And then I got my one-time savings. Okay, and that should be 1, present value of 1. So 1 year, interest rate 6%. And that's the first year only. So that's $5,000 in savings. So that's my $5,000 one-time free rent times the present value factor of a one-time savings, n equal to 1, 6%. That works out to be 0.943. So that I got is $4,715. So the present value of this lease obligation, $37,404. Present value of my lease obligation, $37,404. Okay, so we're going to debit our right of use asset, not 100% of the on the amount yet, but I know I got to credit my lease obligation for $37,404. And if those two are not the same, we know cash is going to be our plug figure. to balance the journal entry. Okay, but we already know that the $1,000 offset each other. Okay, the $1,000 offset each other. Okay, let's see. So we've got the economic life is 5 years. The term of the lease is 5 years. So operating lease or financing lease, since my term 5 divided by my useful life 5, it's 100%. So that means it's a financing lease. Okay, so we met the 75% test. All right, so it's a financing lease. The economic life is 5 years. The term of the lease is 5 years. So obviously we've exceeded 100% is obviously greater than or equal to 75%. So we satisfy the S test. So we know it's going to be a financing lease. Okay, once you've determined it's a financing lease, what are we thinking? I'm going to debit my interest expense. I've got to record interest expense. Okay, so my interest expense, carrying value, my liability times my rate times my number of months over 12. Okay, your lease obligation is going to go down. So my lease obligation, so my cash payment is going to be split between interest expense and a reduction of my lease obligation. Okay, and then we'll credit our cash payment as we're going to see, but we got to allocate your lease obligation. That is your plug figure. That's your payment minus your interest expense. Okay, that'll reduce your lease obligation. Then you've got to record amortization expense. Okay, you've got to tell me what is that right of use asset and the shorter of the economic life or the term, but they're both the same. So there's going to be my amortization expense. So as soon as I see financing lease, I think I'm calculating both interest expense and amortization expense. And not only am I calculating it, I'm actually going to use that. Okay, I'm actually going to do my journal entries. Okay, so right of use asset, $37,405. Lease liability, $37,405. Same thing, operating lease or financing lease. And remember, it just so happened that our signing bonus equaled our initial cost. So since your signing bonus, that makes the right of use asset go down, and then your costs, that makes your right of use asset go up. Since they were both for the same amount, they canceled each other out. So our right of use asset was the same amount as the lease liability because the $1,000 canceled each other out. Okay, so now what is going to be our journal entries? Okay, so as soon as you see it's a financing lease, then we're thinking, okay, we got to record interest expense. We got to record amortization. Again, you could do it in one journal entry. I prefer to do it in two. So 1 of 2, interest expense. I'm going to take that beginning lease obligation, $37,000. Oh, sorry about that. Wrong direction. $37,000. That should be 405. I don't know why I had 404. Sorry about that. $37,405. Shortchange you $1. Don't want to do that. $37,405, our beginning liability. Okay, so this is at December 31, year 1. $37,405 begins as soon as we get control. Okay, times our 6%, and since we got control on January 1, times 12 over 12. Okay, interest expense $2,244. All right, lease obligation. Remember, that's your plug figure, a reduction of principal. So we're going to credit cash. Payment number 1, only $5,000. Okay, same facts as before. So 5,000 minus 2,244. We're going to reduce our lease by $2,756. Okay, that's our plug figure. So that's journal entry 1 of 2. Okay, journal entry 2 of 2. Our right of use asset, $37,405 divided by our term. And since we met the S test, Remember, if it's the S or the N, it's the lower of, rule of conservatism, the term or useful life. Well, they're both 5, so it doesn't matter. 37,405 divided by the 5 years, that works out to be 7,481. So I will debit my amortization expense, 7,481, credit my right of use asset, 7,481. What are we using? T accounts. T accounts are always the way to go. So with respect to our liability, we started out with 37,405. Journal entry 1 of 2, we just reduced it by $2,756. Sorry about that, $2,756. That made the liability go down. So now we've got 34,649, and your right of use asset, we also started out with 37,405. We just reduced it by 7,481. Journal entry 2 of 2. Okay. So by reducing it by 7,481, we now have an asset of, let's see, I can't read my own handwriting. Darn it. Come on, man. Oh, well, whatever. You can figure it out. 37.
Well, I can't read your handwriting either, Pete.
You can't?
Sometimes. But if you can't read it, we certainly can't read it, Pete. Come on now.
Man, you're hurting me. You're hurting me. Why you hurt me like that? Well, this is why I encourage people. You know, you do it with
truth hurts. That's why they need to take their own notes, Pete. Plus, it helps them learn it.
Exactly. 29,924. There you go. So at the end of year 1, and that was per journal entry 2 of 2. This was per journal entry 1 of 2. Okay, so now if they ask you for your ending balances, you got it, you got it, you got it. Okay, so financing lease versus a capital lease, financing lease versus an operating lease. A lot of the questions, many times, especially if it's multiple choice, you can easily cancel out, cross out certain answer choices that have the wrong debits and credits. All right. So our amortization expense, that is constant, same amount each year, straight line. Okay. Your interest expense, though, is going to go down each year. Why? Because your lease liability is decreasing. Okay. The portion of your payment that is allocated towards interest expense on the statement of cash flow, that's operating outflow. The portion that is allocated to liability reduction, your plug figure, your payment minus what you're allocating to interest expense, that's financing outflow. Okay, that'll be financing outflow. Okay, so do not memorize. Do not memorize. T, accounts are your way to go. All right, so this is, obviously, they could ask you, they're probably not going to go out more than 2 years, all right? But like year 2, like where did they get these numbers? So if you're looking for the year 2, your lease liability schedule, well, your interest expense, and this is December 31, year 2, well, where did they get these numbers? Well, you debit your interest expense, we reduced our liability. Year 1, our principal reduction was $2,756, right? So per our T account, you've now got $34,649. So $34,649 times your 6%. Obviously, you get your interest expense, $2,079. Your lease obligation, your lease liability, well, that's going to be now your $10,000 payment. Year 2, minus the $2,079. Now you're going to debit your lease obligation, reduce that, $7,921. And then don't forget your cash payment, $10,000. Year 1, it was $5,000 because we got 6 months free. Okay, that's your journal entry 1 of 2. And then obviously you do your T accounts. You continue your T accounts from here and adjusting. All right, so we just paid off our liability. How much more did we just pay off? $7,921. Sorry about that. We just paid off another $7,921. So if this were the exam, you just reduced your liability, $7,921. So now we have a lease obligation of $26,728. $26,728. Okay, obviously each year your amortization straight line is going to be the same. So then you would reduce your right of use asset, $7,481, and then you would calculate your balance for your right of use asset. Okay, so there's no reason to memorize these schedules. You're going to use your T account. Okay, so 2 journal entries, in my opinion, is the way to go, because I think that's better for you in terms of understanding rather than trying to memorize. So doesn't matter which order you do them, the amortization expense each and every year, since it's straight line, it's the same. And folks, obviously in a task-based simulation, as soon as you see amortization expense, that tells you it's got to be a financing lease. You see interest expense, you know it's got to be a financing lease. Okay, remember your payments, folks. Those can vary. Payments can vary. Okay, so may not be the same each year. So may not be the same each year. So in this example, year 1, we had a $5,000 payment, but in years 2, 3, 4, and 5, it was $10,000. So just watch. This $5,000 payment, we back out $2,244, what we allocated towards interest. There's your principal reduction. Principal reduction, financing outflow, interest expense, US GAAP. For my international students out there, under US GAAP, interest is always operating outflow. US GAAP has no flexibility. All right, when you make a payment that's allocated towards interest, that's automatically operating outflow. Okay, end of year 2. Again, journal entry, 1 of 2, doesn't matter the order in which you do it, that does not change. Okay, so no change. So that's the same. What is going to vary, though, is obviously your interest expense goes down because the carrying value of your liability went down. Instead of using $37,405 as we did in year 1, in year 2, because we paid off some principal, it's now $34,649. Now, watch on the exam. If you've got an annuity due question, the first payment is 100% principal reduction, okay? So the interest expense goes down as the carrying value of the liability goes down. As you're allocating less towards the interest expense, the portion of that payment that gets allocated towards the lease liability is going up, just like on your car payment. And folks, in this question, the second payment was not $5,000, that was $10,000. Okay, not the same thing as what you had in year 1. So it's very important you read carefully about what those payments are. Is there any portion that is free? Okay, and then obviously, once you make your second payment, anything you allocate towards principal, what's happening to the carrying value of the liability, that's going down. Your rate is constant, but your interest expense is going down because the carrying value of the liability is going down. As you allocate less to interest expense, more of that payment goes towards principal reduction, okay? So we are almost done. I like this question. I want to do one more. You ready? One more example, and then we'll rock and roll. Here we go. Rock and roll. Let's go. Determine if Scarface should classify as an operating or financing lease. And then what kind of journal entries are we going to do at the end of year 1, end of year 2? Or excuse me, end of year 1, beginning of year 2. Ooh, look at that. Almost misread the dates. You see that? So what journal entry is December 31, year 1, and then what journal entry January 1, year 2? Interesting. All right, so January 1, Scarf signed an 8-year lease. So the term of my lease is 8 years with payments of $75,000 per year. That's an annuity. When do the payments begin? Due at the beginning of the year. So what do I need? Present value factor for an annuity due. N equal to 8, and let's see, what's my rate? Estimated useful life of the equipment is 10 years. Stop right there. We just met the S test. Special. Snob. The term of the lease, 8. Useful life, 10. 80%. That's greater than or equal to 75. All right, so we're definitely going to have a financing lease. Soon as you see financing lease, what am I thinking? Interest expense, amortization expense. Depreciation is straight line. There's no residual value. Title to the equipment passes. Stop right there. Title, ownership. I also met the O test. The O and the B dominate. So when I get my right of use asset, I am going to divide that by the useful life of the asset, 10 years. If you meet the O or the B, we're going to divide by the useful life. And that's how I'll get my amortization expense straight line. Okay, the lessee's incremental borrowing rate is 11%. The rate implicit, 12%. The rate implicit in the lease is 11%. The 12 is what? Distractor. What's number one? If they give you both, we want the rate specific for the lease. So now I need my present value factor for an annuity due. Ready? So present value factor for an annuity due. And I got 8 payments. The rate we're using, 11%. Let's say that's not given, unknown. Let's pretend that's unknown. You ready? If that's unknown, then maybe they gave you the present value factor for an ordinary annuity. But I would want 8 minus 1, 7 periods at 11%. I would take that present value factor of an ordinary annuity, and then I would add 1 to it. All right? So if you take 7 periods, present value factor of an ordinary annuity, you would get 4.7122. Then I would add 1 to it. 5.7122. So whether they give it to you directly or you back into it, you've got it. Okay, so that's going to be your present value factor if you're an annuity due. So what was my payment? My payment was what amount? $75,000 was my annual payment beginning immediately. So what is the present value of that lease obligation? The present value of your lease obligation? $428,000, $415,000, $428,000, $415,000. That is the present value of your lease obligation. Now, there are no costs. There's no bonus. Okay, so that means the right of use asset, there's no indirect cost, no legal, no commission, and there's no bonus. All right, so let's do it. What's going to be our journal entry? Whether it's a financing lease or capital lease. Financing lease, a capital lease, whatever you want to call it, or operating lease. We're going to debit our right of use asset, $428,000, $415,000. You're going to credit our lease obligation, $428,000, $415,000. All right, so financing lease or operating lease, exact same thing. But here's the key. We use the present value factor of an annuity due. First payment happens immediately. All right, so the first payment happens now, $75,000. So what's going to be our journal entry? So this is at January 1. January 1, we make our first payment. So we are going to debit lease obligation. It is 100% principal reduction. Debit lease obligation, $75,000. Credit cash, $75,000, and that is 100% financing outflow because it's all principal reduction. So T accounts, baby. T accounts are your friend. My lease obligation was $428,415. $428,415. Sorry about that. We just reduced it by $75,000. So at January 1, $428,415, it's now $353,415, still on January 1, because we just made a payment. All right, all principal reduction. Okay, my right of use asset, $428,415. You meet the O or the B. What do we use? O or B. Use the useful life, 10 years, because we're getting title to this thing. Okay. So what's going to be our amortization expense? Well, 428 divided by 428,415 divided by the 10 years. 42, I'm going to round up 842. 842, that is our straight line amortization expense. Okay. So we don't care that that first payment was made on January 1. That is not expense. That's immediately principal reduction. Okay, now at December 31st, that's when we have to record our expense. So I'm going to put that here. Just remember this number, $353,415. So I'm going to put another slide here. Let's go, baby. There we go. Ready? December 31, year 1. I don't care that I'm not making my payment. Okay, I don't care that I'm not making my payment. My second payment's going to happen on January 1. First payment, January 1, year 1. Second payment, January 1, year 2. But we are accrual basis, not cash basis. So I got to record interest expense. How much is my interest expense? Well, what did we just say? The carrying value of our liability is $353,415. So you're going to take 353, not 356, 353,415, multiply it by the rate implicit in the lease, not the incremental borrowing rate. And I know it seems silly, but times 12 over 12, just watch those dates. We got control on January 1. So $38,876. Credit interest payable. We are not making a payment at December 31st. $38,876. Journal entry 2 of 2. Amortization expense. $42,842. Credit your right of use asset. $42,842. All right, January 1, year 2, second payment. That's when we make our second payment. You ready? We debit our interest payable. It's got to be recorded in year 1. Why? Matching principle. We don't care that the payment's not being made at the end of year 1. Even on a 0 coupon bond, even though you're not paying a coupon, you're still recording your interest expense over the life of the bond, right? So our interest payable, $38,876. $38,876. Lease liability. That's my plug figure, because I'm allocating my $75,000 payment between interest expense and principal reduction. 75,000 minus 38,876. What's my principal reduction? 36,124. What are we crediting cash for? 75,000. Now payment number 2 The portion that is for interest, operating outflow. The portion that is for principal reduction, financing outflow. Okay? And now again, you go back to your T account. We just reduced our lease obligation by another $36,124. Okay? So at January 1, year 2, we just reduced it by another $36,124. Payment number 1 was all principal. January 1, year 1. Okay, and then obviously you can find your balance there. Your right of use asset was $428,415. Same thing, T accounts, no memorization of any amortization schedules. All right, so your right of use asset, set up your T account. We were originally $428,415, $428,415. We just reduced it at December 31st, year 1. We just reduced it by $42,842. And then obviously you can find your balance. Okay, your right of use asset, $385,573. $385,573. And then for your carrying value for your liability, we just paid off another $36,124. So at the beginning of year 2, January 1, year 2, $317,291. You can see how this makes for a great task-based simulation, right? All the different pieces of the puzzle, all the moving parts. Okay, folks. So quite a bit of stuff. Quite a bit of stuff. But look, you can and you will do it. Slow and steady wins the race. But how do we start everything, folks? Using your senses. Look, I'm a professional test taker. Between the CPA, the bar exam, the different levels of the CFA, I am no smarter, as you all know. Absolutely. And Megan would attest to this. I am no smarter than any of you. So it's not about an IQ. It's about the time and effort you put in. Slow and steady wins the race. Now, look, Charlotte was talking to you all about time and putting together your study schedule. I don't care how busy you are. You've got to be able to give me 10 hours a week. If you could give me 10 hours a week, if you could give me 40 hours a month, okay, give me 40 hours a month. 40 hours a month. FAR and bar, give me 4 months. Slow and steady. Man, that's 160 hours. For the vast majority of people, that's going to be more than enough time for FAR or bar. Now, look, if you say to me, Pete, I'm out of school for 15 years. Or, Pete, I was a C student all the way through school. All right, give me 40 hours a month, but maybe spread it over 5 months. The beauty of sitting for FAR first, there's no time pressure. So you can take as long as you need. All right, if you give me that 10 hours a week, 40 hours a month, 3 months, 120, reg and TCP, again, depending upon how many tax classes you had. Did you have just individual, or did you also have the corporate, the partnership, the entity, gift, estate, trust? I don't know. Okay, but it might take you 3 months. Maybe it'll take you 4 months. Audit and ISC, give me at least 2 months, okay? Put in the 80 hours, but not in a week. Don't tell me, Pete, I took a week off from work. Spread it out, no less than 2 months. Now, look, there are exceptions, okay? So if you're a super overachiever, you can do FAR or bar in a month. There are people who could do that, but that's not the average, okay? That's not the average, all right? The average is 4 months. You might be able to do it in less than that, okay? Far less than that. All depends upon ABC, your electives, all that kind of stuff. Do you have a part-time job? I don't know. But at just 10 hours a week, man, you can get any part of the exam done. At just 10 hours a week, as long as you're spreading it out. Don't tell me you're taking off from work and you're going to study 80 hours in 1 week. It's information overload. Law of diminishing returns, as Charlotte mentioned, is going to kick in. All right? So you can and you will do it. You just got to be smart about step one, that plan. That's why at UWorld, we take it so serious that every student gets that one-on-one onboarding, because your plan is unique to you.